You know that feeling when the market's been like a roller coaster, up and down, and you just want someone to make sense of it all? Well, that's what we're doing today, taking a deep dive to figure out if this correction everyone's talking about, is it actually over, or are we in for more of those wild swings?
Yeah, it's like you're trying to decide, is it time to kind of relax, maybe even jump back in, or should you batten down the hatches and wait for the next storm?
So before we even get into all that, let's make sure we're all on the same page. When we say market correction, it's not like the whole thing crashing down, right?
Right, it's not a full-blown crash.
From what I've been reading, it's usually defined as a drop of what, 10 to 20%
Right.
from like the highest point it was recently at.
Yeah, exactly. It's a significant dip, but not a total free fall.
And what usually causes these things anyway?
Well, there are a few usual suspects. Sometimes it's just investor sentiment, like everyone starts feeling a little jittery, maybe some bad news starts circulating, or maybe things just got too expensive too quickly, like a bubble kind of thing.
Okay, so it's kind of a mix of psychology and actual economic stuff.
Yeah. I mean, remember earlier this year, inflation was going crazy. The Federal Reserve, they started making noises about raising interest rates. And then, boom, you've got the whole situation in Ukraine and energy prices going haywire. All of that kind of fed into the correction we saw.
Right, right. So now the big question is, have we turned a corner? Are things looking up, or are we kidding ourselves?
Well, let's look at some of the arguments. On the one hand, you have people saying, hey, the worst is over. Look, the market's already bouncing back.
So they're feeling pretty optimistic.
Yeah, and one of the things they point to is, well, if you look at the charts, the market has actually climbed back above some of those key levels, those moving averages they always talk
It
about.
is like 50-day and 200-day moving averages,
Yeah.
right?
Exactly. And these are basically lines on the chart that smooth out the day-to-day noise and show you the overall trend. So when the market moves above those lines, it's kind of a signal that the short-term trend is becoming more positive. Especially, when the 50-day crosses above the 200-day, that's often seen as a bullish signal.
So it's like the market is getting its mojo back, at least for now.
Kind of, yeah.
Yeah.
Another argument you hear is that the market might have been oversold.
Oversold. Does that mean like everyone got so scared they sold everything they could and now there's nowhere to go but up?
Well, not literally everything, but you get the idea. When sentiment gets really negative, people hoard cash, they wait on the sidelines, then any little piece of good news can trigger a big rush to buy back in.
It's like a coiled spring waiting to release.
Exactly. So all that pent-up buying power can drive prices up quickly, even if the underlying situation hasn't really changed that much.
Okay, so we've got the market technically bouncing back, maybe some oversold conditions, but what about the actual companies? Are they actually doing okay through all this?
That's the interesting thing. Despite all the worries about inflation eating into their profits, a lot of companies have actually been exceeding expectations. Their earnings reports haven't been as bad as people feared.
So they're hanging in there.
Yeah, for the most part. And that can be reassuring for investors because at the end of the day, a stock's value is tied to how well the underlying business is doing.
Makes sense. But I have a feeling there's a but coming here. What are some of the reasons why we might not be out of the woods yet?
Well, for one, the Federal Reserve, they're still laser focused on bringing inflation down.
Right, and they're doing that by raising interest rates, right?
Yeah, exactly. And from what I've seen, they could keep raising rates well into 2025.
Oof, that's a long time. And how does that affect the market, those higher interest rates?
It can have a domino effect. I mean, for companies, borrowing money gets more expensive, so that can squeeze their profits. And for regular people, well, it makes things like mortgages and car loans pricier too, so they might cut back on spending.
So the very thing they're doing to try and fix inflation could end up causing other problems.
It's a tough balancing act, that's for sure. And then on top of that, there's the whole question of whether we're headed for a recession.
Oh, right. That's been looming over everything, hasn't it?
Yeah, and there are some warning signs out there. You've got the inverted yield curve, which basically means short-term interest rates are higher than long-term ones. That's often a sign that investors are nervous about the future. Then there's the PMI data, which measures activity in manufacturing and services. That's been declining too.
And those are usually pretty reliable signals that a recession might be coming, right?
Yeah, historically speaking, they've been pretty good predictors.
So if we do end up in a recession, those decent earnings reports we were talking about, they might not last very long, huh?
Probably not. I mean, if the overall economy is slowing down, companies are going to feel it.
Right, right. So beyond the whole recession thing, are there any other red flags we should be aware of?
Well, even with the correction, some people are still worried about valuations.
Meaning stocks are still too expensive.
Well, they're not as high as they were. But if you look at some of the broader measures, like the Shiller PE ratio, they're still above their historical averages.
And the Shiller PE, that's the one that looks at earnings over a longer period, right? To kind of smooth things out.
Exactly. It takes inflation into account, too. So even though prices have come down, some folks are saying they might not have come down enough.
Hmm, that's interesting. And what about all the stuff happening around the world? All those geopolitical risks haven't exactly gone away, have they?
Nope, not at all. The energy markets are still volatile. The U.S. and China, they're not exactly best buddies right now. And Europe is still teetering on the edge of recession.
So plenty of things out there that could still throw a wrench in the works. It's like we've got all these different forces pushing and pulling in different directions. You mentioned something about technical analysts seeing mixed signals too, right? What's that all about?
Yeah, so when you look at the short-term indicators, things like the RSI and the MACD, they're actually showing some improvement.
What do those things tell us again, just to refresh my memory?
Sure. So the RSI, or Relative Strength Index, basically measures how quickly and how much prices are moving.
So like if it's going up, that means more people are buying.
Basically, yeah. It's a momentum indicator. And the MAD, or Moving Average Convergence Divergence, that one helps you spot potential changes in trends and how strong those trends are. And lately, both of those have been moving in a more positive direction.
So short term, things are looking a little brighter.
In the short term, yes. But when you zoom out and look at the longer term charts, there are some things that aren't so encouraging.
Like what?
Well, for one, the recent rallies we've seen, they haven't been accompanied by a lot of trading volume.
What does that mean exactly? Trading volume.
It basically means how much buying and selling is happening. And if volume is low during a rally, it can be a sign that not a lot of people are really convinced by the upward move.
So it's like a party that nobody's showing up for.
Kinda, yeah.
Hmm.
And then there's the fact that the market keeps hitting resistance at those previous high points.
Like it's hitting a ceiling and can't break through.
Exactly. And without a lot of strong buying interest, it might not have the momentum to push through those levels.
Okay, so that's the technical side of things. But what about the people actually putting their money in? You mentioned something about a difference between regular investors and the big institutional investors, right?
Yeah, that's one of the interesting things we've been seeing. Individual investors, everyday folks like you and me, they've actually been pretty active buyers during this recent rally.
So they're feeling more optimistic.
Seems like it. But the big institutional investors like pension funds and hedge funds, they're being a lot more cautious.
Why is that? Do they know something we don't?
Well, they tend to have a longer-term view, and they're probably more concerned about those big picture risks we talked about earlier. The uncertainty about the Fed, the possibility of a recession, those high valuations.
So they're kind of sitting on the sidelines for now, waiting to see how things play out.
That's the impression I get. And historically, when you have this kind of divergence, the institutional investors tend to be right in the end.
Interesting. So what does all of this mean for someone trying to make sense of the market and figure out what to do with their money? Any advice from the experts?
Well, the big takeaway is, don't get too complacent. Just because the market has bounced back a bit doesn't mean we're out of the woods.
So that stay cautious message is still front and center.
Absolutely. One thing that everyone seems to agree on is diversification.
Don't put all your eggs in one basket, right?
Exactly. Spread your investments across different types of assets, different sectors, things like utilities and healthcare. They tend to be a bit more stable during tough times. And some people are even recommending commodities as a hedge against inflation.
Okay, so diversify. Got it. What else?
Risk management is super important too. Having some cash on hand gives you a cushion if things take a turn for the worse. And this might not be the best time to be gambling on risky, speculative investments.
Right, right. Play it safe for now. And lastly, it sounds like staying informed is key.
Definitely. Pay attention to what the Fed is doing, keep an eye on inflation numbers, and watch out for any big geopolitical events. Those can all move the market in a hurry.
Okay, so stay informed, stay diversified, and don't get ahead of ourselves. It sounds like we've still got a lot to watch out for.
Yeah, it's a complex picture and things could change quickly. The thing is, the Fed's trying to control inflation, but that could trigger a recession. So it's like this delicate dance they're doing.
Yeah.
And nobody knows for sure how it's going to play out.
So keep your eyes peeled, folks. The market might throw us a few more curveballs before this is all over. Well, thanks for breaking all this down for us. I feel a lot more informed now.
Glad to help.
And for you, the listener, keep thinking about this. The Fed's trying to control inflation, but that could slow down the economy. How might that tug of war play out? What unexpected surprises might be in store? That's something to ponder as we all navigate these interesting times. Thanks for joining us on the Deep Dive.
If you found this discussion informative, please like, subscribe, and share this channel to get daily discussions on a current economic topic.